Good evening, everybody. Old windy evening here in Mars, PA. Tonight we got the great pleasure of having Todd Gordon with us. Todd has been been trading for quite a few years. He's a regular on CNBC, and he uses Fibonacci numbers to trade the options market, and he also uses indicators that, or employs a kind of a methodology that kind of anticipate the future price versus using lagging indicators. So with that, Todd, we're anxious to see your information. Welcome to the Candlestick Forum.
Well, thanks, Steve. I appreciate that very much, and I know you have a loyal following, and I hope I'll take some time and maybe put some good content on the table for you. So let's just make sure we're okay. Let me get my questions up, make sure we get settled here, and we'll get rolling. All right. Perfect. Guys, how does this sound? Okay. I know this is not the ideal audio setup, but can we make do with it? And okay, perfect. All right, great. All right, so let's have some fun here, guys. This is a backup setup, nothing like kind of thinking on your toes. I've got my normal monitor or my normal trading station. It's all set up for webinars, and for some reason my boom microphone just didn't want to work. So I'm on a cheap Logitech headset on my backup computer. So let's roll with it. Okay, guys, so we're gonna have some fun here. This is, as Steve said, I'm a big kind of leading indicator sort of guy in terms of trading the markets, but I like to have a longer term perspective as well. I like to know what the longer term folks are thinking in terms of fundamentals as well as price trends. And I think as short term traders, it's important to understand what is really happening kind of below the surface, and what are the overwhelming or overriding themes. And I think we're at this point where some major decisions need to be made. Along with FIB, along with sort of these leading indicators, I love looking at what we call intermarket analysis, which is looking at different asset classes and how they play together. There's some serious warning signs coming up, and as Jimmy Buffett says, you got to figure out where you're going to go before the volcano blows. And I think there's a serious period of volatility coming up here, and I want to show you how we're handling it, how I'm positioning my longer-term portfolios, give you some tips and tricks and a couple techniques you can begin trading right away, and hopefully have some fun with it. So let's dive in. Okay, so here's the deal, too. I love interacting with people. I love going back and forth, and my marketing team yells at me all the time because I love looking at the comments and engaging with you guys. I'm going to be a little, I'm going to ignore them a little bit, and not ignore them, but just not acknowledge them as much as I normally would, because I got a good 45 minutes of content to get through. I'm going to hit you pretty hard with this, and if at the end we have time, I'd love to go back and forth. So please don't think I'm being rude. I've just got to get through the content if that's okay. All right. So as always, here we go. The warning, got to do it. You shouldn't be trading with money we can't afford to lose. One, it's just not a good idea. Your wife, girlfriend, husband, boyfriend is going to be mad at you for losing money you shouldn't. Number one, and number two, you don't trade well if you're risking capital that isn't in your comfort zone, right? So this middle part, don't trade with money you can't afford to lose. It's really good advice, because if you're trading with capital you're uncomfortable with, you're not going to trade well. You're going to cut those losers. You're going to hold on to the losers too long. You're going to cut those winners short. So trade with money you're comfortable risking, because listen, you're going to get beat up a few times in this game before you get the hang of it. And I'm 36. I'll show you a little bit about my background. I've been trading since I was 20, and I've seen a few different markets. And one of the most important things is to recognize when you're in a market that requires a totally different kind of set of skills or a tact or an approach. Some markets are quiet and sleepy, and they require you to trade them one way, and then sometimes something snaps, volatility goes, and you got to really change gears. And that's kind of what's happening here. So why is this all happening? Why are we seeing the volatility? Why do I think we're going to continue to see volatility? Well, it's because the Pope just left. And every time the Pope comes, it was the 87 crashed. Pope John Paul was there. At 98 was the Russian crisis, Asian currency crisis, long-term capital management, and then NASDAQ bubble, housing bubble, and then Pope Francis just left. That's the reason. No, I'm just kidding. That was kind of a funny chart from Business Insider, but no, that's not. So a big reason that we're seeing volatility here, and I'm going to try this pen here. I don't know how this works on a note here. A big reason, guys, we're seeing this volatility in the market is the relationship you're looking at right here. So you have the S&P 500, and you have EEM. This is the Emerging Markets ETF. And I've got the breakdown here for you. And wow, that's pretty ugly right there. Basically, 23, 15, 12%, about 50% of this market is Asia. So, we've seen a huge bit of volatility. Let me just see. Where's my eraser? No, I don't want that. Erase all ink on slide. There we go. So we've seen a major bit of volatility stemming from emerging markets, and I think that's a big reason that we're seeing so much going on here. So Asia dropped pretty sharply here recently, and if you take a look at this chart, guys, it's really interesting that the media got so wound up about Asia dropping here. Just this little bit, but if you look at this chart from an intermarket point of view, the S&P has been moving higher for years, and the emerging markets peaked out in 2011 and just gone sideways since. So all of a sudden, everyone's all hot and bothered about Asia and emerging markets dropping, where, guys, this has been at work for years. This has been going on for a long period of time, so this is a big reason. Oil is a big part of it. Oil is very highly correlated to emerging markets. Oil is dropping again today. I think we're heading back down towards those lows, which means the emerging markets are going to come under pressure, which means the S&P is going to come under pressure. All right. So a couple people say, guys, can't see through the curtain. You guys see the emerging markets S&P slide? Okay, just type in yes if you can see what I'm talking about. Okay. And a couple people are having a hard time. I'm just going to continue on, provide you guys can see. Okay, perfect. So a little bit about me. My name is Todd Gordon. As Steve said, my wife Trish and my twin boys Jake and Brody. I am originally from upstate New York, but I worked in the city. I'm a corporate dropout. I worked on Wall Street. I was a senior technical analyst for a major brokerage firm on Wall Street. I traded for a hedge fund. So I was hanging around the city, living in Hoboken, New Jersey. I met my wife in a grocery store in Hoboken, married a Jersey girl, and I'm currently being held captive here, but Bigelow's close by in Pennsylvania, so I got to figure out how far away he is. Maybe I'll go hang out with him. And, yep, love him, hate him. He was at my wedding, so I kind of met him through CNBC. So he's interesting. We'll see what happens. We'll see what happens. Okay, so as I said, I'm a corporate flunk out, corporate dropout. Traded for a big company. I was a senior tech analyst. Now I just run my business trading analysis for my house. I go upstairs and bother my wife and the boys and wrestle around with them. And that's what we do. Once a week I do get out of the house. I do CNBC. Right now Wednesdays are my days, and sometimes they bring me in Mondays for Squawk Box. So I've been on a lot of different shows on CNBC and probably done it 300-400 times, and I'm one of their go-to technical analysts, so maybe you've seen me there. So, James, that's funny. Yeah, I know. I don't love Nogi either. I know, James. Okay, so coming volatility storm. That's a little bit about me. As I said, guys, I've been trading about 15 years, so not that long. I'm still learning the game. I have seen a couple different kinds of markets, and the slow grinding markets, the higher that we saw over the last couple of years, much different animal to what I believe we're in and we're going to continue to be in. So volatility is a completely different animal when you start trading it. And the title of this presentation is Crash or Correction. I'm going to skip to it right now. I'm going to tell you, for some people it's going to be a crash. Some people it's just a healthy correction. Okay, so I think we're in for a major bit of volatility. For those of you who are prepared, it's going to be a simple correction with huge amounts of opportunity. If you're unprepared, it's going to feel like a crash. So the goals I have for you here, I'm going to try to get through them as fast as I can. but have you come away with some actionable information, is I'm going to give you a background of how we got ourselves in this predicament, which, make no mistake, we're in a predicament here. I'm going to show you some of the major players in the markets and kind of how they're handling it. I'm going to give you 3 trading tools that we're going to that you're going to be able to take away and start trading right away. And then we'll also look at some live markets as well. So the first half of the presentation, guys, I'm going to warn you, it's a little bit more fundamental than I usually get. I'm not a fundamental guy. I'm a trader. I mean, I'm a short-term trader. I hold option trades for a couple days to a couple weeks, and that's my bread and butter. But you got to understand what the fundamental crowd is thinking, what they're all talking about, and how it filters down to the short-term time frames. Then in the back half of the presentation, we'll get into some of the trading techniques, if that's okay. So what's going on here? This is a fun chart from a website, zealllc.com. And why are stocks rising? Why are stocks falling? It's because of the Fed's BS, their balance sheet. So you're looking at only 2 lines in this crazy chart. The blue line is the S&P, and the orange line is the Fed's balance sheet. Okay, so I'm going to show you exactly what that means. Come on, baby. It's kind of tricky to switch slides. Okay, so what's happened here is that, let's say the Fed has a Thinkorswim trading account. And prior to 2007, their Thinkorswim trading account had about $800 billion in securities in it. Credit crisis hits, markets almost collapse, markets do collapse, we almost lose the financial system. The Fed's balance sheet goes from $800 billion to $2 trillion to $3 trillion to $4 trillion. The Fed is just basically getting longer and longer bonds in the Thinkorswim trading account. All right? Come on. So just to review, and a lot of you probably know this already, the bond prices, bond yields work inversely. Okay, so as the Fed is buying up the bonds in blue, these are the 10-year note futures, they're pressing interest rates lower, right? And why are they doing that? Well, they're doing it for specific reasons. And again, this is probably a review for a lot of you. Okay, so interest rates going lower. Big reason, guys, they're trying to push those interest rates lower is because that impacts borrowing across all different kinds of transactions. So they're trying to get you to borrow more money on your American Express. They're trying to push interest rates on mortgages as low as possible. And that 10-year yield on the Treasury has the most direct correlation to where 30-year fixed mortgage rates go. They're trying to get you to buy new cars, all this different kinds of stuff, trying to propel the stock market higher. And that makes the Fed happy. Not only are they trying to get you to buy more crap that you don't need, they're trying to force people living on a fixed income with 10-year yields down around 3 and 2%. They're trying to force you into the stock market to basically propel the economy forward. So they're trying to squeeze you out of your safe investments into something way too risky. So it's quite a scheme they got going on. So again, the fundamental stuff, a lot of people are saying, well, the Fed, with all these additions of quantitative easing, QE1, QE2, QE3, QE infinity, will we have QE4? Who knows? Everybody thought that the Fed basically creating money out of thin air and just getting really long bonds in a Thinkorswim account would crush the dollar and send gold through the roof. Well, guys, exactly the opposite has happened. Okay? And really what we're looking at here is this is the Fed's preferred gauge of inflation, PCE, personal consumption expenditures. The Fed would love to see it up here around 2%. This one was taken back in September, and we are well below the Fed's target for inflation. So, guys, I kind of think the Fed is being pressured into raising rates because we've never been through something like this before. And I don't think they're ready. I don't think the economy is going to be able to handle it, to be completely straightforward. I don't know. This is not my game. I'm not an economist, but I think they're being pressured into ending this unconventional monetary policy, and it could have a serious impact on the market. Okay? So we are suffering and continue to suffer from decreasing price levels, or price levels that are increasing but at a lesser rate, called disinflation. Forget everything I say right there. Basically, if commodities continue to drop like we're seeing, commodities get smoked in here. That's deflation. that's bad for stocks. If you start to see the Fed raise rates with falling commodity prices, that is not good. That's disinflation, that's deflation, that's going to really hurt the stock market. Okay, so we're about a month away from probably the first increase in the federal funds rate since pretty much 2006. So we're talking 9 years since we've seen an interest rate increase. So this is going to be very interesting. We need to be prepared. Come on, don't lose me now. Did I lose you guys? Sorry about this. I don't know what is happening with this monitor right here. Let me see if I can switch screens here, guys. Hang on one sec. Bear with me 1 second. Jim, yeah, while I'm setting this up, monitor number, I just stopped sharing my screen. Well, Novi's thinking about this. Yes, I do think the dollar is reversing. I'm actually long the UUP right now, and that is the dollar ETF. I'll tell you what, this is not going to be ideal. This thing is just not acting right. I'm just going to do it this way if that's okay. You know what's funny, Jim? The twins were crawling around down here earlier today, so. Okay, I'm going to make do with this. This is not ideal, but I think it'll allow us to get through. So, okay. So the Fed's going to raise rates. One of my favorite trades right now is actually long the dollar. Okay, and I mentioned that, Jim. The Fed basically, if they're going to raise rates, it's going to be the first central bank out there, and that makes our dollar more attractive. The other thing is the dollar tends to act as a safe haven in down global stock markets. So we could see the dollar moving either way. So I'm going to show you our portfolio in a little bit. So let's talk about some of the talking heads pretty quickly. I don't listen to a lot of them, but there's a couple important ones out there. Robert Shiller, one of the foremost authorities on housing. He authored the Case-Shiller Index. He's basically saying here that overvaluations, he's got indices for overvaluation and confidence in overvaluation. People have never been so worried about valuations right now since just before the 2000 bubble. I mean, really not a good situation. He thinks the S&P is going down to 1,300. Bill Gross, he's saying Americans are being cooked alive by Fed zero interest rates. He's saying that this is a saver's nightmare, forcing people into the stock market, right? So the idea what the Fed was doing is they're trying to drop interest rates so low that companies would borrow very cheaply and take that money and put it back in their company in the form of building infrastructure and hiring employees. And they're not. They didn't. What they did was they played financial games. They did stock buybacks. They basically borrowed money cheaply, bought their own stock, propped up their stock price to make their board happy so they kept their job. And then they did other M&A activities with tax advantage arbitrage in there, merger and acquisition. There's been a big flux of M&A recently, if you guys have noticed that, because everyone's trying to get this done before rates increase. So there's a lot of games that are being played right now, but the point is they're coming to an end because rates are starting to rise. So the corporations that have been buying their stocks and doing M&A deals, that's going to dry up, and that's going to be that's a loss of a major source of stock buyers. Roger, yes. UUP is dollar up. Yes, I'm long UUP, correct. So another guy I like to listen to, and he gets, some pretty controversial stuff out there. He gets a bad name. He does say some pretty crazy stuff. But I want to listen to him, and I'm going to show you why, is Bob Prechter. He is the modern-day Elliott Wave ambassador. And basically, this is one of his charts. He's saying the Dow goes from, where are we now, 18, 19, 20,000, all the way down to less than 1,000 in the Dow. Like less than 1,000. And before you consider this guy a crackpot, let's take a second here and think about this. Okay, a lot of people kind of fear what they don't understand. Adam Smith said that. He's the grandfather of modern economics. But let's see what Paul Tudor Jones and George Soros have to say about that. Soros, who you guys all know, basically is saying in the 1987 crash, this was in the New York Times, he was saying Mr. Prechter's reversal, when he told people to sell in 1987, is what started the crack that started the avalanche. So he's saying that basically Prechter started the 87 crash. That's a pretty impressive testimonial. Soros right now, in this summer, he was long about 1.3 billion worth of index puts, of SPY and IWM puts. So he's short. Paul Tudor Jones, if you don't know him, he's my personal trading hero. He's donated over $1 billion to charity. He's worth $3 billion from his hedge fund. And if you don't know him, you probably never read this book, which you really should, Market Wizards. Paul Tudor Jones from the classic book Market Wizards. He's quoted as just saying this: the reason he's been so successful is because he creates incredibly favorable risk-reward opportunities with Elliott Wave. I attribute a lot of my own success to the Elliott Wave approach. So Tudor was also short for the 87 crash, and he had help from Prechter. And he drew a $100 million payday from being short in 1987. So, you know, before we call Prechter a crackpot, him saying the Dow goes below 1,000, there's some pretty important guys out there who listen to him, okay? And the reason I'm stressing on Elliott Wave so much here is there is a very interesting pattern that happened. It's called the ending diagonal. It's a very specific pattern in the Elliott Wave theory. It just occurred. And let me just show you what it is. It happens after a long advance to the upside. And you start getting just a pattern that looks like a simple rising wedge. So it's a 5-wave move. You go up in 1, down in 2, up in 3, down in 4, up in 5. If you connect those highs, connect those lows, eventually those trend lines will cross. And that is signs that the buyers in an uptrend or the sellers in a downtrend are growing tired and are about to reverse course. And when these things break, it's a really, really sharp reversal. This was a chart that we put out for our customers, our research customers, June 17, 2015. And you can see the ending diagonal. We go up in 1, down in 2, up in 3, down in 4, and then I had it right here. We're looking at the resistance from 2160 to 2170 in the S&P, which sets up a potential 20% drop. And I had orders to sell S&Ps into 2160, and we never got filled. The market only went up to about 2130 or 40 area before we dropped away. So I never got. I mean, we traded the short side very aggressively in here and did well. I was looking for a move down around 1800. We didn't quite get it before. I was looking for 1800 bounce and then back up. We didn't quite get it. We went down to retest the 1900 level, and then we went back up to the highs. And now we're struggling with these old highs. Okay, so I'll tell you what. I need some updated charts. We love the death wedge. Yes, Tudor is an awesome, awesome trader for sure. All right, give me 1 second here. I want to show you guys something else. I'm going to shift gears here real quick. Considering none of my technology is working, we might as well press the boundaries here, right? Okay, here we go. This is what I want. There's some updated trades in here I wanted to show you. Okay, and where we are in the S&P is going to be here. So we were looking for a move down towards around 1800 before we bounce back. And again, this is not a webinar about Elliott Wave. This is not, you know, what I'm here to show you, but it's just how I time the markets. It's just how I lay out my plan. And what I think's happening is I do think we're going to get, there's that wave 4 low we were just talking about. I think we're going to get one more little push up into about 2400 in the S&P. Then I think we're going into this massive period of back and forth. This is very typical in the LE wave theory. We go down, so up in 3. I think we're going to have another test back down into these lows, back up in wave 3, back down in wave 4, back up. So I think for about 3 to 5 years, guys, you're going to be swinging between 2,700 and 3,000 down to about 1,700 in the S&P. I think there's a major period of back and forth volatility. So the title of the presentation is Crash or Correction. Again, if you're unprepared, a drop from 2,700 to 1,900 in the S&P is going to feel like a crash. If you're prepared, it's just a simple correction within a beautiful uptrend since the credit crisis lows. And as I said, volatility presents trading opportunity for you. As I said, when I used to work for the hedge fund, the CIO, the chief investment officer, used to make us do all these annoying, little exercises. He used to make us chart our P&L, our profit and loss, over the VIX. And there was a positive correlation between our profit and loss collectively as traders and the VIX. So I've been through it several times. When you have a VIX spike, generally my profitability goes up. And I think that's the case for most traders. So this is good for us. I can't wait for the volatility. If you're a buy and hold investor in here, or you're a hedge fund and you don't know how to trade it, you're going to get smoked. So let's get into some trading stuff. That's all the crazy fundamental stuff. I hope I didn't lose you there. And again, my technology on my end is terrible. Nothing to do with the room or anything. I just pretty much the worst technical presentation I've ever given. So I hope you guys don't mind. I'm just trying to get through it. Right, as traders, you gotta adapt. So let's get into some trading stuff. Stock market uptrend, currently in grave danger. It's gone just under 300% in 7 years. You can't compare a 1,000-point move in the Dow today to a 1,000-point move in the Dow back in 2009. It's like comparing apples to oranges. Okay, why is that? All right. Well, let's just take a look at the Dow. Okay, uptrend from the credit crisis low to the highs we just saw around 18,000. We're starting to break this uptrend support. If you look at the first swing off the low in the Dow from 49 from the lows, take the first move low to high up to the first swing high there, it's about 4,900 points. Okay, from the absolute low to the first major swing high there, that winds up being a 78.5% move. So if you take another 4,900 point move in the Dow off the very top, 4,900 points, that's only 37%. So you got a 4,900 point move at 78%, a 4,900 point move at 37%. The one up here is roughly half as significant as the one down at the lows. When you're looking at such big moves like we've seen in the markets over the last couple of years, the last 6 and 7 years, you got to change your settings a little bit. You got to look at something called a log scale. It's a setting available in almost all charting packages. It's a percent change distance. It's a physical distance on your computer screen that represents the same percent change regardless of where you are on the price scale. Okay, and I'll show you exactly what that means. So the math, again, stock goes from 100 to 120. It's a $20 move or a 20% move. Stock goes from 150 to 180, $30, 20% move. Stock goes from 200 to 240. This is a $40 move, but still a 20% move. That's what we're talking about here. So what's the point? When you're looking at such long-term moves like we've seen in the indexes, and this is especially important in stocks that have had massive gains over the last 10 years, like Apple pre-split. I have some examples here later on. Apple goes from like $2 to $3 a share post-split up to 130. And if you're looking at this thing on anything other than the log scale, your technical analysis levels are wrong, and you're not trading the right thing. So, I asked you guys earlier, back up here, do you think, and I should have asked you this, do you think the stock market today is still in an uptrend? And just, if you want to type it in, go ahead. But in the back of your mind, say, do you think we're still in an uptrend in the stock market? If you're looking at, and I've got mostly yeses so far, I've got a no. And you guys are quiet there in the chat because you know this is a trick question. So if you look at your regular arithmetic scale, okay, this is your default settings on your charts, we are well above trend. But if you switch it over to log scale and you redraw your trend line, we have broken trend support from the credit crisis low. Okay? We have broken the support. We have come back and retested this uptrend line now as resistance, and it looks like we're starting to back away. So, guys, I think we're going to be in for a serious butt kicking in this market. I'm thinking we're going up to 23 to 2,500 in the S&P, but we might be just doing a double top up here, and we might be starting to roll over. And I could be wrong in the near term, but right that we're going to have a serious volatility bout in the next couple of years. So we'll see. Crude oil, same thing. On your regular, what we'll call arithmetic scale, trend line, we're fine. We're above support at 45, just starting to drop below. You go over to log scale, guys, and connect the low there, and there. We broke support months ago. Crude is already in a downtrend. Apple, we talked about this one. Apple, on a regular scale, arithmetic, support well intact. On a log scale, guys, Apple has broken uptrend support. Very few people know that. This is so important. Can you see the goofy scale? From 0 to 20, post-split, Apple was down at a couple bucks a share. But then you're looking at it up around $114, $120, $130. You look at the scale, that's how you know you're on the log scale, and I'll show you how to do this. Log scale is available on almost every charting package out there. We've broken trend support. That's a problem in Apple. IBM. Even since I've captured this chart, this is the regular one. We're well above trend support there, no big deal. But then if you go here to the monthly and the log scale, 140 is support. IBM is down to like 133 right now, I think. IBM just broke up trend support. And look how far back this goes. This is in the 90s. You're talking almost 20-year uptrend's been broken in IBM. Like, that's not good. I don't think big money managers use charts, Jim. It's unfortunate. Anybody who's been schooled in technical analysis, really a professional, knows pretty much when you get a daily chart or above, you need to be on log scale. Okay, and it's going to change. It's not going to change your moving averages, but it's going to change anything to do with fib. If you're using fib at all, it's going to change the levels. Trend lines, it's going to change it. Trend channels is going to change it. I believe it's going to change the size of your candlesticks. I know Steve obviously is the candlestick master. It's going to change the size of the candles depending on, because the magnitude of the candle is going to change depending on your percent change compared to different prices. So I just use a rule of thumb. Daily chart and above is always on log scale for me. I don't think Jesse Livermore had the technology way back to draw log scales, which is unfortunate, but I think you would have enjoyed it. So, okay, let's keep going. And I love your comments. You guys are drawing me in. I got to stay focused. Okay, tool number 2. These are called measure moves. And this is, we're going to tie a little fib, little LE wave in here, but pretty simple. Okay? And then it's going to seem like I'm getting off track, but I'm really not. So a measured move is a move up. Let's say we have a $30 move. We do a quick setback, a little correction. You're always going to look for the measured move, which is the distance traveled in the prior swing compared to the ongoing swing. So if the prior swing is a $30 move, always watch that $30 move on the upside, because that often acts as a magnet. It can act as resistance, and then it can also act as a breakout point. So watch them. So this is CMG, Chipotle. Okay, we had a $45 move up, a correction in a higher low, and then we had another $45 move up. We tested the measured move a bunch of times before CMG eventually broke away. Symmetry, you got it, Roger. Yep. There's a bunch of names to these. Two steps, symmetry, AB equals CD, an A wave equals C wave. These are basic but really powerful patterns. DLTR, Dollar Tree, a little $11.50 move down, back up, and then the $11.50 move did catch us. We dropped down towards around 12. It was about a $12.30 move, and then we rallied back up. Now here's a key relationship. If the measured move doesn't hold, if it doesn't reverse it, there's still a good trade setup. So when a market breaks through 100% right there, so you have a $10 move up, another $10 move up, it indicates there's underlying strength. So if you get up to the measured move, and let's say the market just kind of messes around below the 100%, below the measured move, look for the 161% projection. So what that means is If the $10 measure move didn't hold, look for the 161% of the prior swing. Okay, so if this was $10, look for an upside target of $16.18. Okay, that's using fib and a little bit of Elliott wave in your trading. And this is simple. You don't need to know anything that's happened anywhere else in the chart. If you have a little $10 move up, step back, another $10 move up, and we're not going anywhere, look for a move up to the 618. This is cable vision. So we got a little move up, AB, set back to a higher low, rally up to the measured move, hang around for a while, and then earnings come out, boom, right to the 1.618. Okay, it doesn't need to be earnings or news or anything like that. Any move that doesn't stop at the measure move target, look for move up to the 1.618 relationship. Those tools are available on all major charting packages. You're jumping ahead of me, JK. Yes, it does. Yes, it does. Yes, you're right. JK is pointing out, yep, you can see how the log scale is going to change the measure move targets. So bonds, I continue to be bullish on bonds, even though the Fed's raising rates. We have a move up in A, setback in bonds. We're starting to mess around here in the bond market. A measure move target puts bonds back at the old high. So if the stock market does roll over, even with the Fed raising rates, I still think the bond market, the long bonds, can continue to push up. And that would, a measure move target puts us at the old highs. So again, they're awesome trading strategies. They provide a fixed target, allows you to plan your exits ahead of time. You know, the motto of my company is plan your trade, trade your plan. Great for options traders if you're trying to pick out strikes. However, they too are jeopardized by these generational size moves. When looking at daily charts or bigger, we require log scales. So this was a trade I was in. This was Alibaba. And let's see, I had the 63-65 call spread going, which I was short the 63s, long the 65, so that's a bearish trade. I was up some money in the trade, and I'm looking at the measured move target coming down. Like, okay, this is the regular scale. You can see how the distance between, you know, every $10 move is the same physical distance on your computer screen. This is the regular arithmetic scale. This chart is saying, well, stay short because we haven't even tested the measured move yet. And maybe we'll even get down to the 1.618 and I can collect full value in those credit spreads. If I had switched over to the log scale, here's the same chart, but on log, it was up around $60, which was the measured move. We had done a double bottom on it, and we moved higher. I didn't make as much money as I was up here on this trade, but I did stop myself out a little higher. Still made some money, but you know, if you were on the log scale, you would have seen we did a double bottom already on the measured move equality target, and Alibaba has been rallying ever since. So pretty cool. So watch those measured move targets on the intraday. You can trade them on a 5-minute, 15-minute, but when you get up on those daily, weekly, monthlies, switch to the log scale and you start looking at percent changes compared to prior percent changes compared to your ongoing percent changes. That's going to give you some pretty good reversals in the market. Okay, tool number 3, above average true range. Okay, you've heard of average true range. How about above average true range? So in order to qualify as a good crash or correction, which is the webinar we're in, we need to test the third AATR, above average true range, like prior crashes. Let's start with the 2008 crash and go backwards. Okay, these are AATRs. So these are average true range bands that go beyond 1 standard deviation. They go up to 2 and 3 standard deviations. So this is the S&P on the monthly. So the S&P monthly comes in, the 2008 crash, we get down to the -2. So the -2 is the first thin band. The thicker one is the -3. The dotted line is the middle band. The first upper thin one is the +2. That's the +3. So we're riding along the +2, +3, and then the credit crisis sets in. We get down to the -3, and we just crush through that one. That was 2008. 2000 was actually a more orderly drop. So we're going up along the +3, we drop down to the middle, go down to -2, test -3, bounce back up, and then we do a double bottom on the -3, and then we're off. So that was a good test of -3. 1987 crash, Black Monday. We were way outside the +3 band there, and then 87 crash was very orderly. I mean, it was a crash, but just went right down to the -2, didn't even get to -3. the -2, and then just right back up towards the highs outside of +3. So 87 crash was obviously very violent, but it was over and done with. 1974. So we're up around the +2, get down to -2, just do a nice little double bottom on -3, and then we're off. 1929 crash. Way outside the +3, down to -2, skid along -2 for a while, and then we definitely test -3 for a couple years. The Dow bottoms at around 40. This was a low 40 in the Dow, 1929 crash. Then we go up. So here is where we are today. Okay, we've been riding along the +3 standard deviation for some time. We're beginning to set back, and you'll notice that throughout this entire rally from the credit crisis lows, we have not tested the -2 or the -3 AATR bands. So what I think is going to happen, and what I said at the beginning, is, guys, we need to test these lower bands. That brings you in around 1,700, 1,600 in the S&P. And then, as I said, I think that's when you start looking for longs that takes you back up to new highs. Then we go down in 4, back up in 5, and then the period, the next 3 to 5 years, going to be a lot of this back and forth volatility that I showed you somewhere up here before. Somewhere up there in the presentation. I don't know. Oh, there it is right there. Right there. This is when we get this huge back and forth. I mean, that could take you out to 2019, 2020 back and forth. So, that's going to get pretty crazy in there. So that's the AATRs, above average range. Just a couple tools that you can look at going forward. So, guys, it's a time where I think we need to really anticipate what you're going to do. If you've been a buy and hold investor, I know we all trade a percent of our capital. I personally trade between 20 and 40% of my capital in my short-term thinkorswim trading account, and I keep other money off to the side. And I don't like to actively trade all of my money. I actively trade a percent of my money. So you need to kind of get ahead of what's going to happen here. So you got to anticipate what's going to happen. Anticipation is the ultimate power. Losers react, leaders anticipate. Tony Robbins, love him. And he's funny because he's paid by Tudor Jones $1 million a year to be Paul Tudor Jones' head coach. So I really take what he has to say. So as I said, how you fare during this coming volatility is your choice. I want to show you some charts. I got to bring up all my charts over on my other computer system here. As I told you, I'm doing this on my backup. But I can bring up my thinkorswim account. We can go through some charts, go through some setups. But I want to show you, if you want to continue on, I do have a really, really nice course that I think would be of use to you. So, as I've said, if you're not prepared, it's going to hurt. If you are, I think it's a time when we can do very well, if you're equipped with the right tools. So I do have a course. It is complete. It is packaged. It has occurred in the past. It occurred in October. It's an on-demand course called Crash or Correction. These are the top 5 tools and patterns every trader must master. Okay, I'm going to show you basically everything I know about trading and excelling in volatile markets. Remember, you can expect to make between 80 and I think it's more like 70 to 80% of your money during 30 to 20% of the time. Okay, I think a majority of our profits come in those high volatile periods, and I think we're coming up on one of those times. I'm going to share with you my tools, techniques, and preferred markets to trade this volatile period. As a bonus, this is an on-demand course that I have available. We cover a lot of different things. It's about the course itself, I'll show you in a second, is about 3 hours, and then we did about 3 days of live trading. As a bonus, I launched something new, which is my portfolio newsletter. I just issued the 2nd edition today, and I'll show it to you. And I'm going to send it out once a week, and it's basically just a complete list of all the holdings that I'm putting in my longer-term money. Right? So it's mostly stocks, ETFs. We're going to do some light options, nothing too aggressive. It will be useful to people who are trading longer-term accounts, IRAs, stuff where you can't go short. So this is just a once-a-week portfolio update, and I'll show you exactly what I'm holding. Okay, so as I said, if you do want some help in terms of how to guide, how to kind of handle your longer term capital through these volatile periods, this is what we're doing. It's not, okay, this is not for people who are looking for the Holy Grail. We do not trade FYE for your entertainment. I'm not going to have you on the yacht with the Wolf of Wall Street by March. Okay, this is for people who can make a decision. As always, we do 100% money back guarantee. It is not an expensive investment, and you guys can have it to start right away. Now, as I said, we do offer a portfolio, and I'm going to show you the one I just put out today. So what I did was I took a $25,000 account with Interactive Brokers, and I just deposited it, and I'm keeping track to the T of all the positions we're holding, how much margin is being required. I'm showing you the entries, the exits. These are our full positions right now. I even just put a trade on in Bitcoin. I didn't get filled yet because I didn't get my account set up, but we are putting a little money into Bitcoin. I'm going to show you how to do that. So we have longs, we have shorts, we have ETFs, we have stocks. I do a write-up and tell you exactly what we're doing in that. So you get that once a week for 3 months. Okay, for 3 months. So 100% money back guaranteed. All right, let me show you what you get, and I'll show you how to get after it. All right, so 1 second. This guy is acting crazy again, right when you guys are ready for the good stuff. Let me just pop that screen up for a second. And I got to get you the link here, and I know I can do this one. Okay, here's what you need. So here is going to be the link. It's going to be real. All right, this is exactly what you're going to need. This is everything you get in the course. So it is it's actually closer to 3 hours of actual content. 3 hours of the content. We did 3 live trading sessions, so that's another 90 minutes. So, you know, the whole thing is going to be close to 10 to 11 hours of content. You get the log scale fib calculator. So it's a spreadsheet that shows you how to do your measured moves. You know, you plug in a couple of points and it gives you your projected measured move based on your log scale. So if you don't have the charts, you just want to plug the numbers in, you get that. I show you how to trade some option strategies, and I have an option strategy selection tool. You get the stop loss, stop trail plan. You get the PAR, positioning tool, percent account at risk. And we didn't even get to talk about this, but I'm going to show it to you pretty quickly. It's a whole process that we go through to figure out how to position size. Okay, before you get into a trade, and really before you start trading, you need to understand what it is you're here to do in the markets, right? So you need to come up with your risk profile, and you got to determine, you know, what's your purpose with this trading account. Do you want to get super aggressive? Are you conservative? You know, whatever. You need to determine your risks for each of your tiers. Tier 4 is your average every day. Tier 1 is your super aggressive trades where everything is lining up. So I take you through this whole process. I give you the spreadsheet, and I take you through the whole process. And basically, when you get through calculating everything, it tells you for each trade how many options contracts or how many shares you should be trading on each setup. Okay, so that's the PAR positioning tool. The above average true range oscillator calculation, we talked about that one. 3 months of my portfolio tracker. And we didn't even get to talk about this one, but I do cover it in the class, which is the swing wave indicator. It's how you pick out your measured move starting and stopping points. So it's a downloadable indicator that goes into all major charting packages, and it'll figure out for you where to start and stop your measured move. So all together, guys, you can get this. It's well over $1,000 value for $97 if you would like to have it. The course is done. It's occurred in October. and we are now in the process of putting out the portfolio newsletter. So if you want, you can get it, and you can begin consuming the material right away. So as I said, there's about 11 hours, and then you'll have the next couple months of 3 months of the portfolio newsletter. Okay, so that is the offer. The feedback from the course was very good. I'm very, very proud to offer the course. I think we did a good job. I covered in this marketing presentation, which was terrible. I just did not do a good job on all the technology, so it happens. But I'm very proud of the course, how it came together, and we didn't really even talk about the marketing class. We did a lot of intermarket analysis, looking at different market relationships, how to do the overlays. We talked a lot about risk management, how to control your capital, how to trade volatile markets, how to trade quiet markets, and basically, if we're wrong and the market just keeps going higher forever, that's fine. We're certainly prepared for that as well. So, some frequently asked questions. You do not need special software to do this. All the major charting packages come loaded with fib and log scales. This is a one-time fee, $97. You're one and done. We are not going to auto-renew you, so you can have it. And if you don't wish to continue with anything we do, no problem. We wish you the best of luck. So we'll keep that link up for 24 hours. tradinganalysis.com/real if you would like to get involved. Rich says, the course was good. Oh, thanks. You already took it, but received no help with the newsletter. You're not getting the newsletter, Rick? You gotta let me know about that. Oh, that's weird. Would you please send me an email to info? Because, we have over 500 people who've taken this course, and everyone's getting it. Rick, send me an email right now as well, and I'll forward it on. But, you might want to check your spam or something. But, yeah, I'll get it to you right away. Send that, but you can also send me an email if you want. Yeah, no problem, of course. Okay, perfect. Sorry, Yassine, sorry for the pronunciation. I don't know about you, but in my view, for the next few years, the best investment will be precious metals, particularly mining stocks. I can see that. Gold actually does perform well in deflationary markets. If we are going to sell off the stock market, gold can act as a hedge. But as I said, one of my favorite holdings right now is the dollar, the UUP. We've broken through downtrend resistance here in the dollar. This one goes all the way back down to the 80s. And as I said, if the Fed's going to raise rates and they're going to continue to raise rates, which means the stock market's probably doing okay, we're going to be the first central bank to raise rates relative to everyone else, and that makes our dollar more attractive, so that should bid up the price of the dollar. We also saw back in here when the stock market was getting its clock cleaned that the dollar acts as a store of value, and our treasury markets act as a store of value for international investors, even though we started the housing crisis. So if the stock market gets crushed again, the dollar has a tendency to act as a safe haven. So I think if stock markets go down, the dollar goes up. If our stock market goes up, I think the dollar goes up. Either way, I think it's going to go higher. Jay says, do you sell or otherwise share our information to other entities for marketing? Jay, Bigelow and I work for the same marketing groups. So our two marketing groups work very closely together. So everything that Steve does, I do. So he runs with a marketing group. I run with a marketing group. We can't be bothered to do all the marketing stuff. We pretty much just show up and do the trades and stuff. So our two companies work very closely together. So the answer is everything that you've experienced with Steve, you more or less will experience with me as well, if that makes sense. But good question. So Jem, great question there. What's your best advice to anticipate trade reversal intraday? So, as I said, this is not my focus all day. I started doing the portfolio because a lot of friends and families, and I had some money managers who follow me and like, Todd, I can't follow your intraday stuff. How do you handle your longer term money? So this started out as really just sending to my friends and family, and people wanted it, and I'm like, let me make a little business out of it. So to answer your question, my bread and butter is this is my website, tradinganalysis.com, and I short-term trade the markets. I swing trade, a couple days, couple weeks. Here's my trade desk, and every single position we put out there is recorded here in the desk. You can go back and look at all our prior positions. I give you exact examples, everything like that. Go to the chart room, and all the styles of analysis that we talk about, you can just log exactly what we're looking at, and commentary, stuff like that. I do a daily video, so you log in every morning, and you get the video. It's 10 to 15 minutes. I outline exactly what I talk about in each video. And all of our trades that we send out, they're all recorded here in the trade desk, and they're also sent via SMS on your mobile phone. So this is my bread and butter. But a lot of people, are too busy to be trading in and out. We'll do 2 or 3 trades a day, and a lot of people are too busy for that. So this portfolio that I'm talking about, this is, I'm going to try to adjust this less than, 3 to 4 times a month. So it's a different. I'm trying to ride longer term trends. So Jem, I'm sorry for the long-winded answer. I'm really sorry for the long-winded answer. The way I anticipate intraday is I'm a big Elliott and Fib guy, as I said. So I'll use the Elliott wave and Fib analysis to predict my entries and say basically, I was looking to buy the dollar down in here, dollar pull back, and we got our entry. So that's how I use my timing for the shorter term stuff. Jose, I talk about this in the course. The most important moving average for me is the 55 EMA. That is the trend indication. I think anything longer than that is too lethargic and it doesn't reflect changes. Anything shorter than that is too volatile. So most important is the 55. And why say 55? Because it's a Fib number. Now 50 is pretty much the same thing, but 55 is a Fib number. Okay. I'm just looking through. Your market projection is also Tudor's view. Well, I don't know about that. I did go to his fundraiser, the Robin Hood Foundation, this year. My old boss was a portfolio manager for him, and he didn't tell me where he was going, but I did watch him raise $50 million in one night for charity. It was unbelievable. So, just reading some other questions. I heard some kind of noise. I don't know if that's a private message or what. Oh, there we go. Interesting. Is that a different link Steve put in there? Let me just make sure I'm giving you the right link here. You guys have any issues purchasing the course here? Did I give you the right one? What's the number one stock to buy puts in for the next 2 to 3 months? Good question. We actually just put in the portfolio. We just went long. We just went short the Russell. Actually, I'll show you that trade right now. Let me make sure I'm doing this right. Today is the 12th. Thanks, Steve. Yep, Steve put in the right. Oh my God. I'm giving the wrong link. Steve will straighten that out. Let me give you a better link here. It's going to be not real, sorry. This one will work as well. But if you guys are going to purchase, please use this one. Stake. Tradinganalysis.com/stake. Thank you, Steve. Okay, and Becky put that in as well. Perfect. So yeah, we did just go into the Russell, and the Russell, the small caps have been much weaker than the Nasdaq and the S&P, and in the last couple of days, you're starting to see the small caps start to take hold on the downside. So I'll go ahead and show you the trade we just put on. And this is the portfolio. We just went into the TWM. That's the double short Russell. So we're getting in at 38.26. We're stopping out at 35. It's 8% risk in the underlying. We're doing a tier 3, and that tier 3 comes in with the position calculator, right? So that will tell you how large or small to trade. So Russell looks like it's set from an LE point of view to start to move lower. And in this thing, I even tell you the shares that I'm trading because I'm trading that $25,000 account live. So I put on 76 shares because it's just a half position size. And we're doing 152 max amount of shares for that Russell trade. Yeah, Amazon just continues to rip on the upside. We are holding some consumer discretionary, XLY, which is that ETF. So you've got Comcast in there, and Amazon, and Disney. So we do have some long exposure. So we'll see what happens there. So, all right, guys. How about any other questions, comments, insults, anything you got? If not, that is the offer. So either way, hopefully that worked. Did anybody have an issue with /real? With the link /real? You bought on the other side? Okay, that's fine. We'll straighten all that out. Can't get the link to work. All right, let me just take a look at this thing. Settle this baby. So if you're going to buy, you just go to tradinganalysis.com/stick. Yeah, okay, that one works. Okay, perfect. And as I said, guys, money back guarantee. If you're not happy, obviously I want you guys to be happy, and I'd like to do business with you in the future and keep Mr. Bigelow happy. I don't think I want to see him grumpy, and that's that. So, as I said, the course happened October 7th. It's on demand right now, and you will receive the second edition of the portfolio when it goes out. So we'll change that to stick. Mike, no, you don't get the daily newsletter with that. You're only going to get the weekly at $97 for 3 months. I mean, that's $32 a week, $32 a month. Can't really beat that. My normal service is $177 a month. So that's when you get the daily video, the text message alerts, and all that. So that's at tradinganalysis.com right there. And then if you do take the course, I'll tell you what, guys, I think it's a good idea to take the course because you'll be offered a $7 trial to my main website. Whereas if you come off the web, come off the street, they make you pay $47. So that's me and my boys. I'm working on this computer right here, and this thing is not working. I'm pretty much going to throw it in the garbage after tonight. My regular microphone wasn't working tonight, so pretty much nothing worked tonight, but that's fine. So if you come off the street, they're going to make you pay $47 for the trial. But if you buy the course for $97, you get the portfolio, plus they're going to give you the ability to do a $7 trial for the main service for a month. So it's better just to buy the course, get the portfolio, do this for $7, and you're really saving $40 if you want to do the trial for the main for the option service. All right. I'm afraid to even bring up charts. Normally I do this, but this computer is just not acting well, so I'm afraid to kind of test anything and bring up charts. But I'd love to go through some symbols, but as I said, stocks starting to break down. Bonds, I think, have a little bit lower to go. Gold, I think, breaks below 1,000. Energy got crushed today. We are short the materials, XLB. Materials and energy were the weakest today. That spells deflation, disinflation. That spells trouble for the stock markets. Russell underperforms. Emerging markets still are just right on the floor. China, FXI, still in trouble. So I'd be careful. Amazon is kind of propelling this whole market forward. Google's doing okay. Apple, I think, is in trouble. Facebook, doing okay. I don't think you can count on the biotechs too much. Healthcare, I don't think, is technically in a good position. So the leadership's getting more and more narrow. Harshad, AATR is above average true range, or if you're familiar with average true range ATR. So that's that. All right, guys. Well, I'm gonna wind it up there, and thanks for bearing with me through that technology. That was, as I said, one of the worst presentations I've ever given. But I hope you guys picked up a thing or two, learned something about what I believe is going to happen. And thanks to Becky and Steve for having me. And guys, I wish you best of luck, and hopefully work with you soon. Okay? Take care.
Thank you very much, Todd. Very good information. And as you can see, for $97, you're going to get a ton more information than you're paying for. So this is a good opportunity to try a system that has been working